Yes, friends, in the last two videos, we had talked about the risk. In the first video, we talked about what is risk. We defined the risk that if we take or anybody takes, rather undertakes any activity, whether financial or non-financial, there is a possibility or the probability of an event or events taking place which, if they take place, may cause the loss. So risk is defined as an event during the course of an activity which, if takes place, may cause any type of the loss to the performer of that activity. Now risk has got both sides. If you take the risk, you may gain also, but if that event takes place, then you may suffer the losses. So mostly the risk is connoted in the negative way, and that is why we define it an event during the course of an activity which, if takes place, may cause us any type of the loss. Then in the second video we had talked about the steps in the risk management, that is, during that activity or an asset is exposed to various type of the risks. There may be a single activity or a single asset, but that may be exposed to a number of events and means a number of risks. So a good person or a well-informed manager or the performer will first identify the risk, that is, how many type of the events can take place during the course of that activity, and understand that event, how does it take place, and give it a name. So first two steps are identify or name the event or the risk, and then understand how does it take place and causes the loss. Then once it has been identified, then one has to develop the skill how to manage that risk, how to mitigate the probability or the possibility of that event happening which may cause the loss, that is that risk. Once that skill has been developed, then one has to know his limits. One has to know the limits, that how much he is capable of mitigating that risk, how much is his ability to control or take that risk. Then next is measuring the risk. How much risk is there? Then we understood, after measuring the risk and simultaneously measuring the return, if he takes that risk and if that event doesn't take place, then how much will he get the return. So risk and return, are they commensurate? Then take a decision whether to undertake that activity or that risk or not. These all steps are before taking the risk. Thereafter, once he has completed the steps and decides to undertake the risk, then the next step is monitoring the risk. Whether, because risk is not static, it will be changing with the environment, with the conditions. So constantly monitor the risk, and thereafter have the risk management tools. And last is, if there are certain events which are beyond his control, then in that case, how to minimize the losses or ensure that losses, that is in the form of bringing the adequate capital like insurance. Adequate capital is nothing but it is a premium like we pay for the insurance and make up for our losses. Similarly, capital adequacy is in a manner or in terms, you can insurance terms we can call it as a premium. So capital adequacy. Now these are the steps. Today we will identify the risk. The first step, how many type of the risks are there. So here we will confine ourselves only to the financial risk. There are many type of the financial risk, but we will talk about only the major financial risk. The most common, widely taken risk is known as the credit risk. Credit risk is what? Credit risk, it is also known as the default risk and also extends to the counterparty risk. Credit risk, because most of the financial institutions, what are they doing? They are borrowing and investing or lending. Now once they lend or they invest, then the money is not in their hands but in the hand of other person. Then when they have conducted this activity of the lending or investment, and the counterparty, that is the where they have invested or they have lent, there is a possibility that the counterparty may not pay back the money in time or in full or at all. This is known as the credit risk. Or because he is not paying in time, so that can also be called as the default risk. That is, he has defaulted in making the payment of his dues in time and in full. And this is also called as the counterparty risk, because the lender is the one party and the borrower or the investor is the another counterparty. The lender, being one counterparty, has completed its part of the agreement. That is, he said that I will be lending you so much money or investing so much money for such a such period at such a such rate, and the counterparty has agreed, yes, I agree to pay back your amount along with the interest in so many months and with so much amount every month, etc. So while one counterparty, the lender or the investor, has completed his part of the agreement, but the counterparty does not, so it is also known as the counterparty risk. These are also further we will understand. There is another which is called as the settlement risk. In settlement also there are two counterparties. So we will right now not go to that. We will only confine ourselves to the simple credit risk or the default risk. Now we might see that because of this credit risk, many financial institutions are suffering, because while they have lent, many banks they have invested or they have lent the money to the borrowers, and borrowers have not paid for various reasons, maybe willfully or maybe the reasons beyond their control, change in the conditions and environment, etc., etc. So they are having lot of problems with this, and this default ultimately results in that asset becoming non-performing investment or non-performing advances. That means those advances which we had given or the investment which we have made, we had expected to get back the amount in full and in time, and when it doesn't happen, that means that asset is not performing as it was expected, or that investment is not performing as it was expected, so it becomes NPA. Now the crystallization of the credit risk results into the NPA or NPI, that is non-performing investment. Now if we apply the steps which we had talked in earlier video, that is the steps. So first step was identify, that is identify the name, yes, it is a credit risk. Understand that how that event takes place. So that we have understood that if the counterparty or the borrower or the investor doesn't pay amount as promised in time or at all or in full, because of either willfully or because of the change in his business condition, the environment, etc., then there will be a default. Now, what was the third? Third was developing the skills. Fourth was measuring, fixing the limit, measuring the risk. Now, these all three will come together. Now, how do we measure the credit risk? Now, the credit risk means the probability of default. Measuring the credit risk means what are the chances that the borrower or the where we have invested, he may not pay the amount in time and full. So measuring risk means what is the probability of losing that amount and the other party not paying that amount. That is called as measurement. Now, banks in earlier days were not having a numerical or a statistical method of measuring this probability of the default. What was happening? They were having the old method of 5 C's. 5 C means first was the character. That will ensure that there is no willful default if his character you have verified. Like Ramchandraji or Yudhishthir or Harishchandra, they will never default. The probability of default is 0 because their character is pran jaye par vachan na jaye. But there are many, everybody is not of that character. So we had to see where is the probability. That we were seeing through watching his character. Then the second was what is his capacity to perform that activity for which he is borrowing from us. And that capacity was his technical capacity, managerial capacity, his financial capacity, like that, his administrative capacity, technological capacity to conduct that activity for which he has taken the loan or the amount from us where we have invested, the capacity. And the third was what are the conditions, both the conditions under which he will be performing these activities. If those conditions are favorable, there are not much risk in those arising from those conditions to the borrower's activities, then there is lesser chance of his default. And that we were doing by constantly monitoring his business environment, regulatory policies, trade policies of the government, etc. Both internal and external. Another was, the condition was, what conditions do we put while granting these advances so that there is no chance of his defaulting and we losing the money. So in loan agreement, hypothecation agreement, pledge, etc., we were putting certain condition which would ensure that there is lesser probability or no probability of default. And in case there is a default, then there is no possibility or very less possibility of loss by taking security and collateral, etc. Then fourth was the capital. As we already told that the lender's money or the investor's money may be lost if that enterprise does not have got the adequate capital to absorb the losses, because every business may have certain conditions beyond his control where it may suffer the losses, and for that he should have enough capital. So while we were earlier looking at the credit appraisal, we were looking at how much capital he is bringing in his own business. And you see, if someone comes to you and he borrows 100 rupees from you. He gives an application that I want to borrow 100 rupees. Now there are two borrowers. Then you say, how much will you be bringing your own money in the capital? Sir, 1 rupee. Another say, sir, I will have 50 rupees, you give me 100 rupees. The first one says, I will put 1 rupee, you give me 100 rupees. Naturally, you will feel safe for lending to the second borrower because his capital has got the capacity to absorb the losses up to 50 rupees. If the losses increase beyond 50 rupees, then only he will not be able to pay back my money. But in the first case, if the losses exceed 1 rupee, immediately my money which I have lent or invested is at stake and I won't get back. So that is the adequate capital. Now fifth is the collateral. That is the security which they are giving. Beside the primary security, if suppose that loses its quality or depreciates and diminishes in its value or otherwise, then there is a collateral available. So we can sell off that collateral and we can get the money. These 5 C's were earlier the core principles of the credit. But now they did not have a statistical measure of measuring the risk. Now here with the Basel II, we have got, or even before that also, we had made a very objective statistical models for measuring the credit risk. You may be knowing, for investors, when they are investing in the bonds are nothing but whosoever is issuing the bonds, he is actually borrowing the money from the investors. So what was happening? These bonds were rated AAA, AA, AA, B, like that. These ratings indicate the credit risk. AAA plus, there is a very less probability of the default, and there is BBB minus, that means there is more probability of default. There is an entire rating methodology, credit rating methodology, which we may talk later on when we will be talking about the rating methodologies of various rating agencies and the problems with the rating agencies. Why these rating agencies failed in 2007-8 that crisis. Now here Basel II brought this rating model. Okay, how to rate? So there were different approach, basic approach, advanced approach, etc. Of rating these credit risk. And certain institutions, they have developed their own credit risk measuring model, like JP Morgan had their credit matrix, etc. For small banks and for the small loans, where it will not be possible to rate them and to for such small amounts, then there is another simpler model which is known as the credit scoring model. So most of the urban cooperative banks adopt that credit scoring model. That is the way of measuring the credit risk. Now in our next video, we will be looking at how the other steps of credit risk management will be. What is that? Measure the risk, fix your limit of taking that risk, and then monitoring that whether the risk is increasing or it is decreasing. Thereafter, we will talk about what are the tools available for managing if suppose that event takes place. Then what are the tools like that credit derivatives? We will understand that they are the credit derivatives. So how do they work like the helmet or the safety belt? And thereafter the capital adequacy. Then we will go back to that for credit risk, how this has been built into the capital adequacy framework suggested by the Reserve Bank. So today we will end up our video here, and in the next video we will talk the remaining things. I thank you all for listening to me, and once again I request you to kindly subscribe to my channel and also forward it to your friends and like it if you have found it useful. Thank you so much.